Hey guys, I'm Paul from Upstart, and thank you so much for listening. As a reminder, we are an outsourced finance and accounting function for startups and high-growth businesses. We handle all of your bookkeeping, taxes, fractional CFO work, billing and operations, with the goal of keeping you efficient, scalable, and saving you time so your founders can focus on what they do best. If you want to learn more about what we do and you're having problems with your own finance and accounting function, just reach out to us at www.opstart.co or find me on LinkedIn, Paul Anthony. Happy to chat. All right, excited to be here today with Neha Govindraj, the founder of Bonside, an amazing startup that has been an Upstart client for a few years, and it has been a great pleasure working with them. And we're going to hear a little bit about her and the business today. Neha, how are you?
I'm good. Thanks for having me. I'm excited to jump into it. It's been fun working with you and the team the past couple of years, so excited for this conversation.
Yeah, likewise, and appreciate that. To start, I wanted you to tell your story because I think you've had a really awesome path that explains where you've landed with Bonside. So.
Yeah, of course. So maybe I'll just start from the beginning. My background. I started my career at Bain and Company working in their consumer and private equity practice. And after a handful of years there, went and started a business here in New York called Glowbar, where we do 30-minute facials. And today we have about 30 locations across the East Coast. And it was in building that business and being in the operator seat, seeing the strength of brick and mortar retail, but also the lack of resources that surrounded that ecosystem, that the idea of Bonside was born, which is really, let's build a growth platform for the brick and mortar industry that is truly built for them by actually understanding the underlying business model, underwrites to that business model, and can open up opportunities that enable those businesses to scale and grow. So our hero capital today, our hero product today is capital, which is what we make available back to business owners, anywhere from as small as a $25K check and as large as a $5 million plus check.
And what's the typical structuring on a financing facility that you provide?
Yeah, so one of the things that we were really thoughtful about when we came to market, when I think about when I was in the operator seat, when I looked at the financing market, there was kind of two ends of the spectrum. On one end, there was traditional debt. So think personal guarantees, covenants, collateral, 6 months plus processes, finding the right bank. And then on the complete other end was equity. And when I was operating the business, there were a handful of venture capital firms that were writing VC checks into brick and mortar. That's since gone down. And neither of them really felt like a perfect match for how we wanted to scale. Like if you think about retail today, it's a lot of small footprint, high growth business models where you want to open 10, 20 doors per year. And neither instrument felt like the right instrument for that. And so in starting Bonside, we didn't just have to offer capital in a centralized manner, but we had to rethink the type of capital that was being offered. And so what we offer here today, Bonside Capital, the way it's structured is rooted in revenue-based financing and revenue sharing. So let's say you have Paul's Pizza Shop with 4 locations and we write $1 million check into your business. Rather than owning a percentage of your business or collecting a fixed monthly payment amount every month, we will collect a fixed percentage of revenue every month up until a certain return is met in our capital. And we keep the revenue shares quite low. They're pretty much always under 10%. And the duration just depends on what the operator is looking for.
Sure. Yeah, that makes sense. It allows you to pay it off faster if you are growing the way you want, gives you a little bit more time flexibility otherwise.
Yeah, exactly. It's like it's really, I think of it as a hybrid between taking the best of equity in that it's a large sum of capital, it's upfront, it's flexible, it's a straightforward process, and the best parts of debt, which is it's capped in terms of the number of dollars you're paying, it's non-dilutive, and we just combine those into a single instrument.
Yeah, I mean, thinking about Glowbar and the size that that business has grown to, I imagine equity would have ended up being quite expensive had you taken that early on. So yeah, there's a lot of benefits. So thinking back to Glowbar and you're noticing this problem and you're trying to figure out the right solution on it, right? One of the unmet needs or innovations here is the type of capital provided, the revenue-based financing. I know you guys also have some pretty unique and technology-driven underwriting that's part of this. So I want to hear about that, and I guess more broadly ask, what gave you the confidence to leave that business from both a right idea and right time perspective?
Yeah, for sure. So the underwriting piece of our technology, we are really focused, and we can do this because of AI now, where over the last couple of years, we've deployed a ton of capital into the market. We've received returns on that capital. And so we have two really interesting databases. One is all of our underwriting decisions to date, and then two is all the outcomes attached to those underwriting decisions. And so we can use both of those data sets to train our own models to now say, okay, why don't you now predictively price what every business that comes in, what sort of terms and offer they should be provided. And so that underwriting engine is made up of a number of variables, anywhere from what is your four-wall EBITDA margin at location number 2 to what is the standard deviation of your revenue across locations. We basically take all of these variables into consideration and predict out what we believe the revenues will look like for a business. And if we can do so within a certain level of confidence, then that is our cue to deploy capital into the business. And so that model itself is continuously being iterated on and trained. We like this tech forward approach because it allows us to get answers to business owners at a faster pace than otherwise. Separately, I think you asked about what kind of led to switching from one business to the other.
Yeah, and why was it the right time, right?
Yeah.
Because when you started, AI wasn't really a thing
Yeah.
yet, and so this was, I guess, a welcome surprise that made it even easier than you thought. But
Right. Well, obviously, I knew AI was coming 3 years from then, and I needed 3 years to build the data tape. No, I'm kidding.
definitely,
No, I mean, really, what made it the right time is I think the level of urgency I felt around the problem. So I remember distinctly when I was at Glowbar, I had structured an agreement with an investor that looked exactly like the agreement that I just described. And the way that I came to that was actually I sat down with a couple of friends that had been doing roll-ups in the pet space, and sat down with a couple of folks that ran franchising models, and I learned about how they structured all the economics around that, and then structured this deal with an investor. And I recall doing that and then speaking with a couple of peers, and I almost felt nervous telling them what I did because I was like, well, this feels like a secret. Like it feels like it needs to be our secret sauce to growing. And it was that kind of feeling where it was like, either this is going to be my best kept secret or I want to build a company out of it and get it into everyone's hands.
If you're going to spread it to everyone's hands, you should own some of the upside that comes from it.
Exactly. I might as well build a business around it. And so I just felt it was just like a very clear draw to solving that problem. And I think around the same time, there was a lot of tailwinds in the retail landscape. It was kind of the beginning of, you were seeing all of these new retail concepts emerge. I could see it even with my own space. There was like competitors emerging left and right because all of a sudden the barrier to entry for brick and mortar started to fall, and so there was a lot more operators coming in. And it was an easy path to ownership and entrepreneurship. And so with all of that boom happening in the space, knowing that all these businesses would need some kind of solution, it made the impetus to switch pretty clear.
Love it. You guys have been deploying for a little while now, right? I'm curious if you have any stories you're able to share or favorite kind of customer success wins from your lending.
Yeah. I would say my favorite stories are definitely the ones rooted in where we've been able to grow with a business as they grow. That was always the vision, which is, it was never about the first check of let's write, $250K or $500,000 into a business. It was always around how do you actually become their growth platform? And we have a business in our portfolio that has taken capital from Bonside 5 times. And I love that because the way that they've approached it is so sound, and it's how our capital is meant to be used. I think particularly when brick and mortar operators look at what's happening in the venture ecosystem, we've normalized, hey, take 10 million up front and then go spend it as quickly as possible. Yeah. And the reality is if you do that with a brick and mortar business, you risk losing the soul of the business. And so it's meant to be built over time. It's meant to be built brick by brick, step by step. And so what our model encourages is to just, for the operator to continue putting one foot in front of the other. And so when you take capital from us 5 times, I love that, because what that meant was, and this is what the operator did, they took the first tranche, opened a door. That door became successful. Then they took the second tranche, opened another door. And they basically went and took our capital exactly as they were deploying it. They never rushed the deployment of that capital. They ensured every location found product market fit. And now they run a really healthy, sustainable business, and they've maintained 100% control of it. And so that's kind of, to me, that's a win-win. And so I love stories like that.
100%. Is everybody that takes capital from you generally opening new doors with it?
Yeah, it's like the number one use case.
Yeah, that's
or
great.
Renovations, things like that.
Sure. Fair enough.
Yeah.
I'm curious, I guess, from a fundraising perspective, like you and I have both raised venture capital rounds as well. You did that for your business. You provide a very different type of financing to your clients. And then you also raised a large debt round in order to actually provide the capital that goes into your, partners and customers, right? So I'm curious specifically about the difference you've seen between raising venture capital and raising that debt that you then could use to go loan to your customers.
Yeah, for sure. Two really different muscles, two really different skill sets. With the debt fundraising, it's a lot more rooted in process. It's a lot more black and white. It's a lot more rooted in track record and numbers and your ability to speak really, really deeply about the asset class that you're investing in and how you're underwriting in that asset class and how you're forecasting returns off of it. I love that fundraising process because I find it to be very black and white. And it's very transparent, and it's not about how you say things, or like if you choose to say the right things. It's just, what is the data and what is your ability to communicate that data. Venture fundraising is different from that, and I also enjoy that as well, so it's not like I prefer one over the other, though if I had to pick, I probably would pick a debt. But venture fundraising is more rooted in storytelling and how you build conviction in others around the bigger vision, and how you storytell around the data that does exist around your business, and how you help folks get to an understanding on it. But there's a lot more that's out of your locus of control. Like a debt firm doesn't have a thesis, a venture firm does. And so it's a little bit more, when you walk into the venture firm and they say no, you don't really know why. It could have to do with your business, it could have to do with them. With debt, when they say no, it's you. And so there's very clear feedback of, okay, exactly what do I need to iterate on, because I know you're putting capital to work in analogous businesses, and there's no thesis thing at play here.
Yeah, 100%. And I really appreciate you clearly have a depth of knowledge when it comes to finding the right financing structure for a given business, which I think is totally underappreciated in the entrepreneurship world in general. And I mean, there are a lot of conversations I have with people starting businesses where I essentially challenge, is venture capital the right financing structure for your business? But especially, I think, since like 2020, roughly, it's what everyone thinks of first, right?
Yeah.
And it's either that or a bank loan, but there is a whole range of alternatives in between and outside of those things that might be better fits for certain types of businesses.
Definitely, and it was something that in starting Bonside, at the time when we started Bonside, even for brick and mortars, it kind of felt like venture capital was the North Star. And it was, there's a lot of buzzy venture capital backed brick and mortars launching around then. And the reality was, there's, maybe 5 VC funds that invest in brick and mortar. They're maybe writing 3 checks a year. So there's 15 brick and mortar businesses that get venture funding every year. There are far more than 15 brick and mortar businesses opening every year. And so one of the things that we had to be really cognizant of, I probably made a decision that I don't think most fintech founders would make, which was one of the first investments I made was in our brand identity and our logo and our design, because I wanted a brick and mortar, when they spoke to us, to feel like we were on par in terms of prestige with venture capital, because we had to break down the historical notion that venture capital is number one and everything else is number two for the brick and mortar operator, because that's just not true for their business model. So rather than fight that, we just had to kind of play the game.
Yeah, 100%. It also aligns you with your audience, I imagine. Like the typical brick and mortar founder cares a lot about brand and visuals and, in ways that other industries may not. But if you guys are trying to appeal to consumer focused audiences and founders, showing that you have the same type of visual identity and appreciation for a brand, I think is probably important. We feel that way for startups, right? That we don't want to look like a typical accounting firm when you
Right.
see us, because I want to appear somewhat like-minded and that we can speak the language, right?
Totally. I mean, and that makes a difference. Like, I think part of what that desire stems from is, and I remember feeling this when I was sitting in the operator seat at Glowbar, was you just want to feel like there are people that have your back. And, the journey of entrepreneurship is really lonely, and there is a lot of hardships, and you just want to feel like there are other people there fighting for you and have your back. And so part of what we really focus on in our messaging when we're talking to business owners is like, we've got you. Like, there's a spot now that you can come to when you need capital. You can reliably access it. And by the way, we're here if you need other things as well. And that's what I do think the venture capital industry did a really great job of in their go-to-market as an industry, is communicating and conveying, hey, we're not just a check, we're actually a partnership, and we're going to help you, and we've got your back, we're going to write press releases for you, and all the soft things that actually do matter for businesses, because it makes them feel like they're in business with someone.
Yeah, it became a little bit of a meme where people poke fun at like the VC, let me know how I can be helpful type of thing.
Yeah.
But I mean, if you actually talk to enough founders out there, you'll realize that the stories of VCs being incredibly helpful and making like a real needle moving difference it's not uncommon. And the worst case scenario is you get a check and then they don't add much value, right? So yeah, they get kind of too bad of a rep in that area, but the good firms really can help in big ways. And you are backed by some investors that I think very highly of, so I'm sure that's been the case for you.
For sure.
You mentioned the operator seat there, and I want to talk a bit about that because you've been the operator of a brick and mortar business and now of a venture-backed fintech business. And I'm curious, I guess, what's universal across those experiences and what's very different?
Yeah. The day-to-day is very different. What like the actual work that you do, the way that you build the business, how you goal set around the business, the team that you arrange around yourself, all of that is totally two different businesses. And I am very grateful to have been in the operator seat on both sides, because I feel like I've gotten to learn so much by being an operator at Glowbar and being an operator at Bonside. The things that are the same is what it takes of you and what it requires of you, and just kind of what you need around yourself. So it's like the personal parts stay the same, which is it requires everything. I mean, you know this, you just wake up thinking about the business, go to bed thinking about the business. You want to surround yourself with the best people for the business. You want to think ambitiously about the business. You want to have the right partners at the table for the business. So all of those qualitative things are the overlap, but how you actually spend your time, how you structure your day, how you structure your teams, that is what's the high contrast between the two models.
Yeah, definitely. If you were talking to someone that wanted to be a founder and you didn't know which path they were taking, they were either going to go venture backed or brick and mortar, what's one piece of advice that you would give that would be directly applicable and needle moving across both?
Applicable to both paths?
Yes, universal.
How badly do you want to do it? Or how much, how
100%.
How badly do you want to do it?
100%.
It's
become
ringer.
I think that being a founder has become kind of a cool thing now that people want to do, just like socially.
Yeah.
And it's so hard and so stressful.
Totally.
You absolutely need to want it so badly. You don't need to want to quote unquote be a founder. Like, you need to want to build a business and accept the stress that's going to come with that, because it is crazy.
Totally. I feel like the best wins come after the hardest losses. And so it's all around, like, if you want it badly enough, a hard loss turns into a big win. If you don't, a hard loss turns into walking away or giving up.
Yeah, there's a VC that I know very well who has always said that the adage of every startup fails for the same reason because they run out of money is not true. Every startup fails for the same reason. It's because the founder runs out of steam. And that I believe is true. It's really, resilience is underrated, and you have to have such a firm belief in what you're doing in order to push through the difficult paths.
Totally. I mean, most people don't believe in it, which is why you're building it. It's why it exists.
That's exactly right.
Yeah, so you kind of have to become numb to that a little bit, which like I forget sometimes now because it's just I just expect no one to believe what we're doing. I'm just like, obviously, why would anyone believe in it?
Yeah. And speaking of like the unexpected, I guess, stress that can come as a founder, this is something I talk to people about a lot, and I have a bias in this area, but I think people, especially if you're a newer founder, first-time founder, right, there's a temptation to try to go plan for what you need right now instead of planning for what might happen unexpectedly down the road and investing in resilient infrastructure across your business, right? And you guys had a story that I'm curious if you'd be able to tell recently where things went very unexpectedly wrong with regard to a tax credit, and we were able to navigate through it. And I think it'd be a good lesson for other founders to maybe learn from.
For sure. The way that I mean, in general, I kind of, as it is going in and starting whatever business you're starting is going to be hard and it's going to be challenging and you're going to be problem solving constantly. It's a poor use of your time to be problem solving on the things that you are not the expert on and there are people that already know the solution for. Like, what I want to spend my time problem solving is how do you underwrite this business that has never been underwritten before, and how do you do it in a way that's repeatable and you do it in a way that it can be done in under 5 minutes. That's the problem I want to solve. What I don't want to solve is how do I get my tax credit from my payroll provider. I do want the problem solved, I just don't want to solve it. And so when I think about setting up the infrastructure around Bonside, it was, and this was a learning coming out of Glowbar as well, as I was just like, okay, the things that I know I need in my corner is I need good legal, I need good accounting, and then I need like a good fractional network that I can lean on for one-off things. And so we got a good legal partner, and then with you all, we brought you guys on, not just because we needed the transaction of closing our books every month, but because there's a lot that comes up in accounting that I frankly don't want to think about. I don't want to have to problem solve on, that you guys are experts on and you've problem solved for it once before, and so you know how to get to a solution. And so there are, like, I think people don't realize how much value there is in that. So if I think about even what happened with the tax credit, that was about 60 grand of tax credits that would not have come our way at a point in time where, you know, when we're forecasting cash flows, we're banking on that coming our way. Any other business that was with any other payroll provider had gotten their version of their 60K back. And one I didn't have visibility into is that everyone else had already gotten their tax credits back. So at first, when it was said to us from our payroll provider that we're not getting it back because of an IRS delay, it's very easy for me to accept that because I'm not going and surveying all the other founders to see if they got their tax credits back. And it was your team that was like, yeah, that's wrong. All of our other clients have gotten their tax credit back. And I was like, well, I'm over my skis here. I don't really know how to fight for it. And I'm very grateful for you guys because I just threw you on CC and you guys ran with it. But fast forward, 6 weeks later, I've got my 60 grand and it was a lot of, pulling teeth in order to get there, and having a partner like you guys where you don't have a response. It's not in your scope of work for you guys to go chase our tax credits for us, but it's the benefit of having a good partner at the table is when things like that come up, there's just this mutual trust of, okay, we know we're the experts at this. We're going to be more effective at fighting this fight for you. Let us go to bat and do this, and it'll pay off in the long run. And it's just that kind of mutual understanding. And I do think, especially as like all of these services become AI native, I'm like, I even think about it back in the brick and mortar space. I'm like, yeah, like there's AI native accounting firms and whatnot, but you still need an expert that's going to be able to fight for the tax credit for you and is going to be able to, I think I called you guys last week being like, hey, we need someone to audit our books, and we've got this like one covenant that we want to make sure we don't trip. And that kind of on-call help doesn't get solved for with a piece of software.
Yeah, I totally agree on this front, even aside from my bias, but I think that the two things that come to mind, for one, you talked about like, what are the problems that you want to spend your time on? And that's something every founder should be thinking about. There's a quote that I reference often from as Jack Altman, founder of Lattice, who said, as a founder, your only job is to make sure that you only do your 3 jobs, which is building a team, talking to customers, and like fundraising, I think was the third one or something like that.
Yeah.
And I think that's like, you clearly have that single-minded focus on like minimize the distractions aside from those things. And then secondly, yeah, when you talk about like the difference between the AI native accounting firm, which I'm not hating on that space, and the actual hands-on service provider, to me, it comes back to like, you're a financing person, obviously, right? Like, what's the risk reward on either side? If you go with the cheapest possible solution for accounting or legal, right? Like, you can save a few bucks along the way, doing it that way. And if everything goes perfectly and you never hit a snag in those areas, then congratulations, you saved a fairly immaterial amount of money on your path to success. Like, that's not going to, the difference of $400 a month, is not going to make or break your business. But if something comes up that is a make or break moment, right? Like, you're going through diligence and you realize your books are wrong and you can't ask a chat bot why they're wrong and how to fix them. You're going to be glad you invested a little extra in a partner that you actually trust. And that's how I feel on the legal side too. Like, I'm always tempted to just go into Claude and like draft legal documents, but if it's really an important one, I got to make sure it's right. And the extra assurance, it's kind of like an insurance thing, right? Like, just paying a lawyer to make sure it's done right, at least give it a review, is the smart move.
Totally. And there's a little bit of, I think what's also like, when you're a startup, it's, I don't have a bookkeeper on my team, and I don't have a, full-time general counsel. So it's like, if I had all those things, maybe I could be more reliant on just the AI native solution being my only form of having outside help. But especially when you're a startup and you don't have that internal team, and I probably won't build that team for a bit, and there might never be, at some point there'll be a bookkeeper, but for a while, because one, there's AI native solutions that you can pair with like accounting teams that you get the personnel aspect too for the couple hours you need it a month to do the task of the repeat task of closing books and things like that.
Yeah, and like, that's why I don't hate on AI by any means. Like, we use it a lot on the back end to make our service more powerful. I think that you should not work with accountants or lawyers who are unfamiliar with AI or unwilling to use it, but you also shouldn't put all your chips in the AI basket on it, right? Like, have some quality people behind the scenes that can step in at high leverage moments and can place the right guardrails on the technology.
Yeah, 100%. Agreed.
All right. Thank you so much for taking the time to chat today. I really appreciate it, and I really love working with you guys. It's been a real pleasure.
Of course, and the feeling's mutual.